So you think about the roller coaster of the last few years. 2020 is a big recession in basically every region and country besides Australia, besides China. Massive sort of sympathy rebound in 2021 as the impact of government stimulus comes in, consumers start to spend, businesses spend on COVID-related investment, which is necessary to function, as well as the real pickup in demand growth we see in the back, really starting in the second quarter of 2021, a really big surge in investment sort of across the markets. 2022 for most countries is basically just coming back down to reality. So most regions are going to grow a little bit above long-term trends, still making up for a little bit of the sort of decline we saw in 2020, and also benefiting from this very strong demand we're seeing really across markets. You've got sort of two exceptions to this rule of basically a little bit slower, but still very good growth in 2022. The first exception to this rule is going to be Asean, where we sort of brought it up quite a bit. Asean is really struggling in 2021 with this most recent Delta lockdown. And so 2022 actually sees, in our forecast estimates, slightly better growth as they sort of get through Delta and get back to basically a more open consumer spending environment and continue to benefit from strong external demand for especially light manufactured goods. Your other real exception here is LATAM. And the reason I flag Latin America is because you can see after pretty good sympathy rebound in 2021, you have quite weak below trend growth in 2022, and that continues into 2023. So from a structural perspective, Latin America stands out as being rather weak coming out of COVID. Part of that's the impact of lost tourism, part of it's domestic politics, which has turned in many cases populist, and part of it is the imposition of very strong fiscal and monetary controls designed to offset the decline in the currencies. But now what you have is a bad combination of very tight policy or tightening policy combined with relatively weak domestic fundamentals and relatively high domestic inflation, although that we do expect that to start to come down. But across your developed markets, in particular, US, Western Europe, slight declines in 2022, but still the US is still above trend growth here. It's just 2021 growth in the US was so explosive. And in Western Europe, still quite above trend growth in 2022. There's a range of factors supporting both global demand and global, sort of suppressing global demand as we go from 2022 past into 2023. So 2022 in a lot of ways looks like a pretty good environment, especially for developed markets again. So you have the vaccination spread, you've got loose monetary policy across major developed markets, and that actually supports growth in emerging markets. So in both ways, that's really important for supporting global demand growth. And you've got quite strong demand in what's a relatively tight operating environment. And we've seen this in terms of capacity utilization has been increasing. We see it in terms of shipping, sort of manifesting how tight the operating environment is. We see inventory to sales ratios are very low in most countries. But we do expect that to slightly start to ease across the back half of 2022. So as we start to see some of this really, really strong demand start to sort of level off and then sort of reduce a little bit, especially as new capacity comes online, we do expect some commodity prices to ease, along with some of the shipping logistics challenges. Combined, those should help to support global demand because it will break some of the inflationary pressures and mean that governments can still maintain an easy stance on monetary policy. Factors suppressing global demand in 2022 are almost entirely an issue in emerging markets. So we've got this global fiscal impulse turning negative, which will really have a bigger impact on B2Gs in emerging markets as governments start to tighten their belt and see where can we make cuts. Ongoing COVID-19 disruptions mainly are going to impact emerging markets, as we previously discussed. And we have inflationary pressures, which we think will ease, but will persist. In that we mean the prices that increased last year and in 2021 will basically stay at similar prices. It's just price growth will slow. So we won't see outright deflation. We'll just see slowing inflationary growth. And that's mainly going to be driven by non-commodity input costs falling. So we expect that this sort of wage cycle that we're seeing in a lot of markets will start to level off. Going out past 2023, things look a little bit shakier. Again, especially for emerging markets, because we're going to start to see tightening policy. So once we're past COVID, government stimulus stops. And so that means we're going to start to see monetary tightening, which will put on a lot of pressure on exchange rates. We're going to see more fiscal discipline in emerging markets and possibly as well in developed markets. And we will see some ongoing logistics challenges as companies try to rejigger these supply chains that created such issues recently. So I think 2022, by and large, looks like a pretty great year, a good year for spend. 2023 plus, really you want to design yourself to be as resilient to some of those offsetting declines in fiscal spend, monetary spend, out past 2023 as possible. So again, just looking at a heat map, this is just growth rates year over year, so it doesn't tell the whole story. You can see here on our sort of vertical bar, as low as we go is 0. Very few countries are growing at 0 or negative rates, Venezuela being one of them. Global growth average in 2021, we're expecting was 5.6%. So the global economy in aggregate did recover to pre-COVID levels in 2021, mainly driven by the very strong growth in China and the US. That creates sort of support for the entire economy via both the export engines as well as remittances being paid out from the US, for example. 2022, 4% growth is what we're forecasting, still rather strong. Here what you're seeing is where do we see the year-over-year growth taking place. And again, most regions it's above trend growth. So the US looks yellow, that's actually still quite good growth, quite supportive for global demand. Where you're seeing this weakness that's a bit unanticipated will be areas across Latin America in particular, parts of Asia Pacific, which are still languishing a bit. And then obviously Russia is sort of hanging in here a bit lower than you would expect given the pretty significant increase in commodity costs that we're seeing.
Ryan, can I ask a question here?
Yeah.
So when I look at this and I think about this level of growth, I look at 2022 at 4% globally, 2023 3.6%. So slowing, but still growth. And I imagine that if the 2023 heat map looks fairly similar to this, maybe the scale is adjusted a little bit, but probably the same countries that are growing maybe at a slower rate and that sort of thing.
Yep.
So I don't think there's any outliers truly affecting 2023. So when I think about all of that, I look at it and I say, there's still a lot of risks that feel like they're mounting. And, whether it's tightening monetary policy, big deficits, more tensions geopolitically. There's a lot at play here. And I guess when do you see, if at all of this coming home to roost in terms of recession or some shock to the growth picture here?
Yeah. So I think there are definitely risks on the horizon that could cause that kind of growth shock. But the way we're modeling, by and large, most countries right now, if you think about this in terms of what you'd say in a normal business cycle, this is not a normal business cycle because COVID was fundamentally different from a normal business cycle. But
COVID almost reset a whole new different type of business cycle. Yeah.
Yes, accurate. But in a way, what we're seeing here is global capacity is relatively tight. And we're kind of in what you'd think about as an expansionary phase of the global economy. We expect that to continue across 2022. I think 2023 is where we're really going to start to see, and as a result of that, we're seeing very strong investment, shockingly strong in 2021, and with very positive sort of tailwinds for 2022 investment. I think in 2023, we're going to really start to see a little bit of competition really return to markets in a way that makes new investment look a little bit more challenging. Because instead of dealing with an issue where you can produce as much capacity as you want for certain products, and you'll find companies to buy it, the issue is really how quickly can you get it to them? It's going to start to shift towards, oh, we actually built our inventories. We actually have logistics networks that are well functioning now. And because the sort of delay between product order cycles and delivery is shorter, you actually don't need as much capacity. So I think 2023 becomes that turning point where you start to get a little bit more selective. And that's going to lead to some of the sort of decrease in the global growth push that's being driven by really fundamental investment into the global economy, which is really being driven by cash balances by very, very wealthy corporations and wealthier countries. Come 2023, you're really going to have to get back to a consumer-driven, local-driven growth environment to find upside. So looking at the heat map at a country like Brazil, that's very low growth for Brazil in a recovery cycle. The hope is that they can get over their political challenges and get back to sustained growth by driving domestic investment, which will largely be services based. And I think a lot of countries in the world, that issue of how do we pivot away from this external global demand push this fiscal spending push by governments into sustained domestic growth is a challenge. And the most obvious one suffering with this right now is China, with questions about whether Evergrande is going to be a real change in the Chinese model. But a lot of countries, I think, in the emerging markets, Mexico among them, Brazil, South Africa for sure, India, a lot of the countries we've come to rely upon for our sort of growth push in EM demand are starting to fade. And the risks associated with those markets are really starting to pick up, I think, in the minds of investment. Developed markets, barring policy choices, should sort of weather this storm relatively well. It's that delta that's being added by emerging markets that we're afraid of, and that means that global growth might slip from a 3.5% long-term trajectory down to a 3 or even like a 2.5 range. And that has a lot of implications, especially for forecast views for commodity prices, which could further impact those emerging markets.
All right, now before we continue, you've teased it a couple of times, and I was going to wait till a little bit later to ask, but we might as well dive in on China just while we're here real quick. And specifically, we are getting questions from clients about Evergrande, and is